Yo, what's up, guys? Back here again. As I promised, I'm going to do my dividend video. I really love this. I recommend this to a lot of people, even though I can't give them financial advice. But I do bring it up a lot. I bring it up over real estate and a lot of other things just because I grew up and we did real estate when I grew up. I had to do rental properties, help out with that, and I know they can be lucrative, but they're just very time consuming. Very time consuming. They can be very rewarding. Um, the problem is they involve a lot of you. They involve a lot of time up front and a lot of capital. These involve hardly anything up front. So it's very easy to get into these and very easy to start seeing your progress. So this isn't going to be directly pertaining towards AMC or anything. My channel is not going to be 100% about AMC because obviously that's not going to be a forever thing, even though it feels like it. So this is going to be very basic about dividends. I'm going to get more in depth into it later. Try to help you guys understand it a little bit more because some of these are going to seem a little intimidating. I know some of you guys have seen this, I'm sure, but some of you guys might not know what some of these terms mean and stuff. So, like BDCs or business development companies or ETFs, like exchange traded funds. So I kind of break them down a little bit more in a later video, but this is just going to be kind of bare bones and basic. Why I really like them, and I think you guys will like them too. So yeah, I'll jump right into it. I'm not going to tell you guys exactly what my portfolio is yet. I don't want you guys to compare, to feel like you have to compare yourself to me and do what I just do. But the good companies are out there. If you see them, that's probably something I'm going to be in anyways. So my dividend portfolio, real quick before I jump into it, it's going to be probably, the blend will probably be yielding me about 6 to 8% a year. That's pretty good. I think most stocks out there that are on the higher end usually yield about 4 to 5%. The reason why I'm going to get away with that is some of these covered call ETFs give you a massive dividend, which is not technically a dividend. I won't get too far into it in this video, but they do provide you with that income. There's different tax implications on that, but generally, dividends are they're a non-earned income type of money. So it's passive income. You're not earning it through like a job or something. So you get that advantage as well. I didn't write that down, but yeah, blue chips. So those are going to be your big companies like McDonald's or like IBM. Real big companies like that. They're going to be real sustainable. They don't grow a lot, but they do. They're very stable. They have massive amounts of capital. Very safe in that perspective. Put your money in, and get dividends. Usually they pay about every 3 months. If you get enough of them, one of them, they all pay different dates, so you can kind of cover them, spread them out, over a wide range. So that's one of my goals too, to kind of get paid more consistently. You might have, instead of getting paid every 3 months, if you pick one stock, you'll get paid. If you pick enough, you might get paid every, week, every couple weeks, from a different company you own. So that's really cool. BDCs, business development corporations, those are going to be a lot more obscure, like White Horse Finance or like Main Street Capital. What those companies essentially do is they loan money out to middle to medium to small companies. Basically, they're kind of like financial institutions. They offer financing for them. They don't grow very much at all, if any, but they do provide massive amounts of dividends too. They're just not quite as stable, but there are some that are fairly decent. And White Horse Financial is one that I really like. Just me. Covered call ETFs like the RYLD, QYLD. Basically, they trade stocks on the NASDAQ, big blue chip stocks and things of that nature. But what they do is they do options trading against them, and it's not technically a dividend, but it is paying you out as if it is a dividend. But it's just a different tax implication. Not something I want to put all my eggs into one basket on, but they do like provide a hell of a return, 12 to 13%, and that's something cool. You put your money in, and you still got your money, and that's what's cool about the dividends. You put your money in there, you still have the money as if it's in savings, but you're investing in a company, and they're paying you as a thank you just for investing in them. So that's awesome. And yeah, let's see, mutual funds. Those are going to be more like their ETFs are similar to the mutual funds. Off the top of my head, I can't tell you the exact difference between them. They're very similar. I think I'm trying to think of it. They're both basically a basket of stocks. The fees are just a little bit higher in ETFs, I believe. Mutual funds are a little bit less. I think that pretty much equates to the return a little bit, because some are actively managed, I believe. So I think you pay a little bit more for your fees, which aren't huge. You can look them up right on the website, and it'll tell you. And a hell of a lot better than a bank interest, saving. I can tell you that right now. I'm sure you guys know that. But a lot of the advantages of this. This is a lot of psychology. I love psychology, but progress is instant, which means you can see and not really feel, but you can see, the fruits of your labor automatically. All you're doing is throw money in, and you see in your portfolio, hey, you start getting, a little bit of money in. It's not much, but that psychological feeling of, hey, this is giving me something in return, that's really cool, yeah, it psychologically boosts you. It's very positive for your psyche, and it's more likely to keep you going. Provides consistent income. So, yeah, if you're in good companies, it's going to keep coming in and keep paying you those dividends. You don't have to worry about tenants, like with the real estate. I'm not saying that real estate is like the worst thing in the world, but it can be. It's very involved, and a lot of people love it. That's fine. I'm not trying to distract anybody from that if that's their thing. You can get really good returns. You can get a lot of tax breaks, and but I'm telling you, you will put in the work. You will. It's not that easy. So don't let anybody fool you. This isn't easy either, but it's a different kind of not easy. You just have to take time and put the money into it. And, if, we get paid as good as we are from, like the short squeeze or something, this can be very lucrative right away. Say if you make, 100,000 just from the squeeze, after taxes, an 8% return is going to pay you at least $8,000 per year. And that doesn't sound like a lot, but when you get, a few $100s every couple of weeks or something like that, it means the difference between, like having to pay for groceries like that a couple of weeks or not. So that's pretty big, and that's just a minor, that's a minor example. But another thing is it's low stress. Like I said over here with the real estate, you're not having to worry about tenants trying to sue you or breaking your stuff, which they seem to always do. Trying to keep the unit filled, making sure the utilities are on. Broken toilets at 2 a.m. Using the toilet while the water doesn't work because they're not paying the bill, type of stuff. Yeah, I've seen a lot of stuff. So, like I said, not trying to scare anybody off from the whole thing, but over the years, I've really come to appreciate dividends as well. And you can do real estate as well too. You can add this into it, whatever you like. And there's a lot of other things too. These are just like some of the most common ones that people can do for passive income. Pros, easy. Obviously, you put money in your brokerage account. You buy the stocks that do provide a dividend. You can look at that. and you can do it with very little capital. I mean, a lot of apps you can open up a brokerage account for no money anymore, like, you know, Robinhood or something. I know Robinhood gets a lot of flack, but you know what, a lot of brokerages, they do stuff that would probably blow your mind. So just because all eyes are on like a Robinhood or something, I mean, doesn't mean that they're the worst people in the world. They just got the notoriety. So I'm in them, so I'm not that worried about it. And I know a lot of people that I even follow online that have, you know, $2 million. They have all their money in Robinhood, so I wouldn't be that worried about it. They're SPIC insured, so your money's covered. Let me see what it says here. Try to read my handwriting here. I try to point this out for you guys, so because I know my writing sucks. I try to write it, you know, as neat as possible. I'm gonna come back to that because I don't even remember what that says. Time. So that's one of the cons is it does take a lot of time. You're going to be more consistent, but you'll probably be more likely to stay with it as well because you're not getting your ass kicked with it. It's going to psychologically boost you every time you put money in. It's just giving you that much more back. It goes by a percentage of what you have invested in there. So that's really good. One of the other cons is there's no tax breaks like in real estate. So, you know, your financing on your real estate, you're not getting some of those tax breaks, you know, every year on, you know, buying, you know, real estate and getting, you know, getting credit and things of that nature. So that's one of the cons there. And I'm still trying to read this. I really can't read that. I'm sorry about that, but man, I should have wrote that a little neater. I thought I had that written a little bit more, but I hope that explains it a little bit better for you guys. I kept this very basic, very bare bones, because hell, I made this 12 minutes, and if I get more into it, like the different stocks and, you know, the payout ratios, you know, keeping your payout ratio under 70% and things of that nature, I mean, I could have made this a whole hell of a lot longer. But yeah, I'm picking a blend of like blue chip stocks, you know, all of these pretty much, and more so in this area, and maybe a little bit in here. This is more for beginners. The mutual funds and ETFs, a lot of people want that, you know, quote unquote security because it's more safe. I know, put, you know, quotes on that. That's not necessarily true, but a lot of people try to give, you know, beginners that illusion that, you know, it's more diversified, so it's safer. And, you know, yes and no. If you get a good solid company, like especially like a Coca-Cola or, you know, like a Starbucks, something that's been around for a long time, especially Coke, and you look at their balance sheet and you know how to, you know, identify like, you know, their expenses and things of that nature, you're going to realize pretty quick, like, once you get that in depth to it, you could probably put all your money in it, essentially, not giving anybody advice, but, and you probably be just fine, you know, making, you know, almost 3% on your money. But, yeah, I hope that gives you a basic, you know, understanding of why I like these, you know, some of the things like that, and, I want to hear your comments down below, you know, of course, like and subscribe. Not trying to be clickbaity, but I am trying to provide you guys really good value. I'll keep this short, I'll end it now. Love you guys, take it easy, and I'll see you next one. Peace.